the mid-year recap of Security Bank Trust and Asset Management Group, also our outlook for the rest of the year. I'm Dino Aquino, your head of fixed income for Security Bank Trust and Asset Management Group.
And I'm Roces, Chief Economist of Security Bank.
Well, actually for the past 6 months, we experienced very high inflation for the first 2 months, right? But since then, it actually has been trending in the right direction. So, needless to say, there's a lot of volatility, especially during the first part of the year. But as we proceeded towards the latter part, first quarter and second quarter of this year, there was some clear direction that bonds are trending in the right direction, meaning it's moving in the positive direction for the investors. But nonetheless, we can't take out the fact that there's a lot of volatility, especially after the start of July, where the Fed starting talking rate hikes once again, as we've seen the bond yields actually fluctuate. But if you look at on a year-to-date basis, interest rates are still a lot lower by around 40 to 70 basis points on a year-to-date basis. So in turn, bond investors are experiencing positive returns.
You mentioned volatility. We're still seeing that.
Yes.
We're still seeing that, but we're bullish towards the returns because the yields are tracking the inflation rate, and our projections show that inflation rate is actually temporary up until the end of the year. That actually validates the view that returns are positive for bond investors.
If the BSP signals they're done, then that would actually have a positive impact right away on all asset classes, not just the bonds. But if you look at the curve in itself as we speak, it will have an immediate impact on the short end. In your 1-year treasury bills, we're experiencing around 6% yields in terms of the 1-year bills. We're gonna see an immediate impact. So once they start saying that we're done raising rates in the hiking cycle, that would actually have an immediate impact right away on the short end of the curve, specifically the 1 to 3 year tenor bonds.
But here's the thing, they might not signal that they're done.
Or a cut.
Or a cut, yeah. There's still some upside risks to inflation. You have wage hikes, you have transportation hikes, we have El Nino upcoming. The general view is that the BSP will be pausing along with the US Fed. Given those upside risks, they might not announce just yet, given the fact that they might have to move in tandem with what the Fed will be doing, or if upside risks actually materialize.
Now is a good time to invest in the fixed income space.
Perfect time.
It's a perfect time actually. The start of the year, we saw the market super positive. Like everyone's going, oh, there's gonna be a rate cut at the end of the year, all of that. So the bond market actually rallied quite a lot during January and early February. But since then, it actually has been seeing some pockets of correction already. So as we speak, if you look at the bond curve where it is right now, we're actually at March to April levels. So we're basically back to the middle of the range. So with that, especially if you're not able to invest at the early part of the year or even late last year, now is an opportune time to invest. And also, if you're already invested, it's also a perfect time to top up your investments.
Let's talk about the top 3 indicators. So let's talk about growth first. We're looking at a growth rate of around 6.3% this year. So that's, given that there were base effects from last year as well. So that's quite decent growth. That's within the target of the government. We're looking at private consumption, which is 75% of GDP, remaining robust. Despite inflation, despite high interest rates, we're observing that consumption pattern still there. So we could probably say it's already back. Business as usual.
Business as usual.
It's the same consumption pattern.
Even pre-pandemic, close to that level.
Yes.
If you look at how activity is.
And considering as well that revenge spending has already slowed down, but that's still robust levels. So there could be some slowdowns in terms of the overall general consumption, but it's still very strong. The other thing is there could be some pullback in terms of government consumption, which affects GDP as well. So all in all, that's still very good level to be at in terms of the projections for the year. We have other multilateral agencies also looking at being within the target. 6.3, that's not a slow number or a low number. That's actually one of the strongest projections in Southeast Asia. Second is inflation, which is the major challenge. We're looking at an average of 5.4% this year. considers the very high levels that we have for most of the first half. We're looking at inflation falling within target by the fourth quarter, if not earlier. So that's actually very good optics in terms of the inflation fight. We have to watch out for levels in the first half of next year. If El Nino and the wage hikes and transport hikes
And the base effects.
the base effects as well
Start
actually pushes inflation up. We're positive in the trajectory of inflation. Positive in the sense that after suffering from it for a very long time. Yeah. Third would be FX. Right now, we're seeing a lot of volatility. It changes on a daily basis. It's very hard to pin down. So we have been doing this a very long time. This year, it's very difficult to do the forecast. Right now, our fearless forecast is 55.5 by the end of the year. We have very good fund managers here in Security Bank, so you might want to listen to them. We give periodical outlooks and updates on terms of the market, so we have a very good batting average.
Well, I'm gonna use a quote, but it's a bit old, but probably overused. It's actually a very good film. You should watch it. Dead Poet Society. Quote there is, "Carpe diem, seize the day." It's now time for you guys to try investing. That's it. Hope you enjoyed. See you next time.
See you.